Welcome to our comprehensive guide on managerial finance. In this video, we'll explore the essential concepts that drive financial decision-making in organizations. Managerial finance is all about using financial information and tools to make strategic business decisions. Whether you're a student, a professional, or simply curious, understanding these principles can help you navigate the world of business with confidence. We'll start by breaking down the core areas: capital budgeting, investment decision-making, and financial planning. Each of these plays a critical role in ensuring a company's long-term success. Let's begin our journey by understanding what managerial finance truly means and why it's so important in today's business environment. Capital budgeting is the process companies use to evaluate potential major projects or investments. It's a crucial part of managerial finance because it determines how resources are allocated for long-term growth. Imagine a company deciding whether to build a new factory, purchase expensive equipment, or expand into a new market. These decisions require careful analysis of costs, expected returns, and risks. Capital budgeting helps managers compare different opportunities and choose the ones that align best with the company's strategic goals. By using financial tools and projections, managers can make informed choices that drive the business forward. The capital budgeting process typically involves several key steps. First, managers identify potential investment opportunities. Next, they estimate the expected cash flows from each project. This involves forecasting how much money the investment will generate over time. Then, they assess the risks and uncertainties associated with each option. After gathering all the necessary data, managers use financial evaluation techniques such as net present value (NPV) and internal rate of return (IRR) to compare projects. Finally, they select the investments that offer the best balance of risk and reward, ensuring the company's resources are used effectively. Investment decision-making is at the heart of managerial finance. It involves choosing where to allocate the company's funds to achieve the highest possible returns. Managers must weigh the potential benefits and risks of each investment. This process isn't just about numbers, it also requires strategic thinking and an understanding of the company's long-term objectives. By carefully analyzing each opportunity, managers can avoid costly mistakes and ensure that every dollar invested contributes to the company's growth and stability. When evaluating investment opportunities, managers look at several factors. They consider the expected return, the time frame for receiving returns, and the risks involved. Tools like payback period, NPV, and IRR help managers compare options objectively. For example, a project with a high NPV is likely to add more value to the company. However, managers also need to consider qualitative factors such as how the investment fits with the company's strategy and market trends. By balancing quantitative analysis with strategic insight, managers can make sound investment decisions. Present value, or NPV, is a key tool in capital budgeting and investment decision-making. NPV calculates the present value of future cash flows generated by an investment minus the initial cost. If the NPV is positive, the investment is expected to generate more value than it costs, making it a good choice. Managers use NPV to compare different projects and prioritize those that offer the highest return. Understanding how to calculate and interpret NPV is essential for making informed financial decisions. The internal rate of return, or IRR, is another important metric in managerial finance. IRR is the discount rate that makes the NPV of an investment zero. In other words, it's the rate of return at which the project breaks even. Managers often use IRR to compare projects with different cash flow patterns. A higher IRR indicates a more attractive investment. However, it's important to consider IRR alongside other metrics, as it doesn't account for all risks or the scale of the investment. Payback period is a simple way to evaluate investments. It measures how long it takes for an investment to recover its initial cost through cash inflows. Projects with shorter payback periods are often preferred because they return the investment faster, reducing risk. However, this method doesn't consider the time value of money or cash flows beyond the payback period. While useful for quick assessments, managers should use it alongside more comprehensive tools like NPV and IRR. Assessing risk is a vital part of investment decision-making. Every investment carries some level of uncertainty, whether it's market fluctuations, changing regulations, or unexpected costs. Managers use various techniques to identify and evaluate these risks, such as sensitivity analysis and scenario planning. By understanding potential downsides, managers can develop strategies to mitigate risks and make more resilient investment choices. Effective risk management helps protect the company's assets and ensures long-term stability. It's not enough for an investment to be profitable. It must also align with the company's overall strategy. Managers evaluate how each opportunity fits with long-term goals, market positioning, and available resources. Strategic alignment ensures that investments support the company's mission and vision, rather than diverting resources to unrelated projects. This approach helps build a cohesive business strategy and maximizes the impact of every dollar spent. Financial planning is the process of setting goals, developing strategies, and outlining the steps needed to achieve financial success. In managerial finance, this means creating detailed plans for budgeting, investing, and managing resources. Effective financial planning helps organizations anticipate future needs, allocate resources efficiently, and respond to changing market conditions. By taking a proactive approach, managers can guide their companies towards sustainable growth and profitability. First step in financial planning is setting clear, achievable goals. These might include increasing revenue, reducing costs, expanding into new markets, or improving cash flow. Managers work with stakeholders to define these objectives and ensure they align with the company's overall strategy. Clear goals provide direction and a basis for measuring progress, making it easier to track success and make adjustments as needed. Budgeting is a core component of financial planning. It involves creating a detailed plan for how resources will be allocated over a specific period. Managers estimate revenues and expenses, set spending limits, and monitor actual performance against the budget. Effective budgeting helps prevent overspending, ensures resources are available for key initiatives, and supports informed decision-making throughout the organization. Forecasting is the process of predicting future financial conditions based on historical data and market trends. Managers use forecasting to anticipate changes in revenue, costs, and cash flow. This allows them to prepare for potential challenges and seize new opportunities. Accurate forecasting is essential for effective financial planning, as it helps managers make proactive decisions and avoid surprises. Resource allocation is about deciding how to distribute limited resources among competing priorities. Managers must balance short-term needs with long-term goals, ensuring that critical projects receive the funding they need. Effective resource allocation supports innovation, growth, and operational efficiency. By regularly reviewing and adjusting allocations, managers can respond to changing circumstances and keep the organization on track. Monitoring financial performance is an ongoing process in managerial finance. Managers track key metrics, such as revenue, expenses, and profitability, to ensure the company is meeting its goals. Regular performance reviews help identify areas for improvement and allow managers to take corrective action when necessary. This continuous feedback loop is essential for maintaining financial health and achieving long-term success. Financial statements provide a snapshot of a company's financial health. Managers use the balance sheet, income statement, and cash flow statement to analyze performance and make informed decisions. These documents reveal trends, highlight strengths and weaknesses, and support transparency with stakeholders. Understanding how to interpret financial statements is a fundamental skill for anyone involved in managerial finance. Balance sheet shows a company's assets, liabilities, and equity at a specific point in time. Managers use it to assess the company's financial position and liquidity. By comparing assets to liabilities, they can determine whether the company has enough resources to meet its obligations. This analysis helps guide investment decisions and resource allocation. Income statement summarizes a company's revenues and expenses over a period, revealing its profitability. Managers analyze this statement to identify trends in sales, costs, and net income. By understanding where profits come from and where costs are rising, managers can make targeted improvements and drive better financial results. Cash flow statement tracks the movement of cash into and out of the business. It helps managers understand how well the company generates cash to fund operations, pay debts, and invest in growth. Positive cash flow is essential for financial stability, while negative cash flow can signal trouble. Monitoring cash flow helps managers maintain liquidity and avoid financial shortfalls. Budgeting process involves several steps, starting with setting objectives and gathering data. Managers then develop detailed budgets for different departments, allocate resources, and set spending limits. Throughout the year, they monitor actual results against the budget and make adjustments as needed. This process ensures that the company stays on track financially and can respond to unexpected changes. There are several types of budgets used in managerial finance. Operating budgets cover day-to-day expenses, while capital budgets focus on long-term investments. Cash budgets help manage liquidity, and flexible budgets allow for adjustments based on actual performance. Each type serves a specific purpose and helps managers control different aspects of the company's finances. Capital structure refers to the mix of debt and equity used to finance the company's operations and investments. Managers must decide how much to borrow versus how much to raise from shareholders. The right balance can lower costs and increase returns, while too much debt can increase risk. Careful analysis helps managers choose the best financing options for their company's needs. Cost of capital is the rate of return a company must earn to satisfy its investors and lenders. It serves as a benchmark for evaluating investment opportunities. If a project's return exceeds the cost of capital, it's likely a good investment. Managers calculate the cost of capital by considering the costs of debt and equity, as well as the company's risk profile. Working capital management focuses on managing short-term assets and liabilities to ensure the company can meet its day-to-day obligations. This involves monitoring cash, inventory, and accounts receivable and payable. Effective working capital management helps maintain liquidity, reduce costs, and improve profitability. Cash management is about ensuring the company has enough cash to meet its obligations while maximizing returns on idle funds. Managers use techniques like cash forecasting, optimizing payment schedules, and investing surplus cash. Good cash management reduces the risk of running out of funds and supports smooth operations. Inventory management involves balancing the costs of holding inventory with the need to meet customer demand. Managers track inventory levels, forecast demand, and implement systems to minimize stockouts and excess inventory. Effective inventory management improves cash flow and supports customer satisfaction. Managing accounts receivable means ensuring customers pay their bills on time. Managers set credit policies, monitor outstanding balances, and follow up on overdue accounts. Good receivables management improves cash flow and reduces the risk of bad debts, supporting the company's financial health. Accounts payable management focuses on paying suppliers and vendors efficiently. Managers schedule payments to take advantage of discounts and maintain good relationships with suppliers. Timely payments help avoid late fees and ensure the company's reputation remains strong. Sometimes, companies need short-term financing to cover temporary cash shortages. Options include bank loans, lines of credit, and trade credit from suppliers. Managers evaluate the costs and benefits of each option to choose the best fit for the company's needs. Short-term financing helps maintain operations during periods of low cash flow. Long-term financing supports major investments and growth initiatives. Common sources include issuing bonds, obtaining long-term loans, or selling equity to investors. Managers consider the costs, risks, and impact on ownership when choosing long-term financing. The right mix supports sustainable growth and financial stability. Dividend policy refers to how much profit a company returns to shareholders versus reinvesting in the business. Managers balance the desire to reward investors with the need to fund future growth. Consistent, well-communicated dividend policies can attract and retain investors, supporting the company's market value. Financial ratios are tools that help managers analyze performance and make decisions. Common ratios include profitability, liquidity, and leverage ratios. By comparing these metrics to industry benchmarks, managers can identify strengths, weaknesses, and areas for improvement. Ratios provide valuable insights for both day-to-day management and long-term planning. Profitability ratios measure how efficiently a company generates profit from its resources. Examples include return on assets (ROA) and return on equity (ROE). Managers use these ratios to assess performance and guide decisions about investments, pricing, and cost control. High profitability ratios indicate strong financial health. Liquidity ratios show how easily a company can meet its short-term obligations. The current ratio and quick ratio are common examples. Managers monitor these ratios to ensure the company has enough resources to cover immediate needs. Strong liquidity ratios reduce financial risk and support operational stability. Leverage ratios measure the extent to which a company uses debt to finance its operations. The debt-to-equity ratio is a common example. Managers use leverage ratios to assess financial risk and determine the company's borrowing capacity. Properly managed leverage can enhance returns, but excessive debt increases risk. Financial forecasting helps managers predict future revenues, expenses, and cash flows. By analyzing trends and market conditions, managers can make informed decisions about investments, staffing, and resource allocation. Accurate forecasting supports proactive management and helps companies stay ahead of the competition. Scenario analysis involves evaluating how different situations could impact the company's finances. Managers create best case, worst case, and most likely scenarios to prepare for uncertainty. This approach helps identify potential risks and opportunities, allowing managers to develop flexible strategies and respond effectively to change. Sensitivity analysis examines how changes in key variables affect financial outcomes. Managers adjust assumptions about sales, costs, or interest rates to see how results change. This helps identify which factors have the greatest impact and where to focus attention. Sensitivity analysis supports better decision-making and risk management. Financial controls are policies and procedures that help safeguard assets, ensure accuracy, and prevent fraud. Managers implement controls such as approval processes, audits, and reconciliations. Strong financial controls build trust with stakeholders and support the company's long-term success. Technology plays an increasingly important role in managerial finance. Financial software, data analytics, and automation tools help managers analyze data, streamline processes, and make faster decisions. Embracing technology improves accuracy, efficiency, and competitiveness in today's fast-paced business world. Ethics are essential in managerial finance. Managers must act with integrity, transparency, and fairness when making financial decisions. Ethical behavior builds trust with investors, employees, and customers, and helps avoid legal and reputational risks. Upholding high ethical standards is key to long-term business success. Financial regulations set the rules for how companies manage and report their finances. Managers must stay informed about relevant laws and ensure compliance to avoid penalties. Regulations promote transparency and protect stakeholders, making them an important part of managerial finance. In today's global economy, managers must consider international factors such as exchange rates, foreign investment, and cross-border regulations. Globalization creates new opportunities and challenges, requiring managers to adapt their financial strategies. Understanding global finance helps companies compete and grow in international markets. We've covered the essentials of managerial finance, from capital budgeting and investment decision-making to financial planning and control. Understanding these concepts empowers managers to make informed decisions, drive growth, and ensure long-term success. By mastering these tools and techniques, you'll be well equipped to navigate the complex world of business finance. Thank you for joining us on this journey through managerial finance.